we're going to go ahead and get going here.
All right.
All right, so good evening. My name is John Stahl. I'm with Atlantic Bay Mortgage Group. I'm the sales manager here at our office in Savannah. In addition to managing the office, I also originate mortgage loans. So I want to thank you for coming tonight. You know, the most important thing, right, in the home buying process, in my opinion, is educating yourself, right? So let me ask a question. Start off with this. So how many of you here think that buying a house, getting a mortgage can be somewhat of a difficult process? Yeah. I should see every hand go up. Come on, put them up. I know that everybody, thinks, right? It can be a daunting, sometimes, a little intimidating process. So the most important thing that you can do, right, as a prospective home buyer is to educate yourself. So that's what we're here tonight, is to educate you along the whole process here to make sure that you're comfortable with it. So we are going to cover really everything that has to do with buying a house. And it's going to start with finding the right real estate agent. That is one of the most important things in the process, is finding the right agent. And the reason why that's important is that you want to find an agent that understands, your needs as a home buyer. You also want to work with somebody that you're comfortable with working, right? So somebody that kind of, has the personality, has the knowledge, has the experience, so that they can help you find the right house. Finding the right lender, right? So we want that right lender to be Atlantic Bay Mortgage and myself, hopefully. I'd like to certainly do your mortgage loan, but you want to be comfortable with the mortgage banker that you're working with. We're going to talk about the home shopping process, kind of what goes into, your thought process and analysis when it comes to, hey, what's the ideal house for me, right? What's the right neighborhood for me? All those different things that go into the process of finding a house and eventually making an offer. Pre-qualification. This is the most important thing when it comes to understanding the finances behind purchasing a home, right? You want to start with your mortgage banker and you want to get pre-qualified. And the reason why you want to do that is because you're going to know for sure, right, that you're going to be qualified for that mortgage to purchase that home before you make the offer. Loan programs, we're going to talk about loan programs. There's a number of loan programs available today. Conventional loans, FHA, VA, USDA. There's some down payment assistance programs that we're going to talk about. Credit scores, okay? Credit scores, right? Credit is a very important part of qualifying for a mortgage. So we're going to talk a little bit about credit and how that impacts your ability to qualify for a mortgage. Debt to income ratios, that's going to be an indication of how much of a mortgage you can afford based on your income. PITI, you know what PITI stands for? Anybody?
Principal, interest, taxes.
You got it, man.
Yeah.
Principal, interest, taxes, and insurance. So when you make your mortgage payment, and I'll show you here on another slide, how the mortgage payment is it's comprised of those very things. Everything but your condo association fees, that's separate. I know you're thinking about buying a condo, so the condo fee is not part of your mortgage payment. And then we'll talk a little bit about closing costs and how they come into play. So here's some tips for finding the right real estate agent. First, you want to do your research, right? You want to, probably one of the best ways to find a realtor, right, other than walking in the doors here at Engel and Völkers and talking to one of the agents here, referrals, right? You probably have a friend or a family member, maybe somebody from church, has bought a house recently. So you want to ask, you want to find out maybe from, your friend's family, who have they used in the past and who are they happy with? Who do they like working with? Social media is a great way, right? Facebook, there's a lot of promotions that go on Facebook with regards to homes and their listings, right? So, Facebook is a great way to find potential realtor. Realtors, not every realtor is going to be as experienced as others, right? Some have more experience than others. Some know neighborhoods better than others. Some specialize maybe out in the Pooler market as opposed to downtown. So that's another thing that you want to look at. You also want to look at, that realtor's expertise and, their ability to help you find a house in the area that you're looking. It could be condominiums. There's certain realtors that specialize in condominiums, and they know all the condominium projects. They're very familiar with them. So that's somebody that you might want to talk to. Next step is once you found your realtor, really you want to talk about the mortgage. You want to talk about, that affordability and how much you're able to afford based on the purchase price and that price range that you're looking at. So some tips for finding the right lender. Look, we all know that buying a house is probably going to be one of the biggest investments that you're going to make in your lifetime, right? So you want to pay close attention to a couple of things when you're talking to a lender. One is the time that it takes to close a mortgage loan. So there are some lenders out there, and not all lenders are the same. They're different. So you've got options where you can go to a big bank, right? Like a Bank of America, like a Wells Fargo. You can talk to a mortgage professional that's at an independent mortgage company. Atlantic Bay is an independent mortgage company, so we're not affiliated with a bank. All we do, mortgage loans. That's it. That's all we specialize is residential mortgage loans. So we're able to actually close mortgages on a home purchase quicker than a lot of the big banks because we don't have all the extra departments and overlays and compliance issues and things that a big bank might have. Nothing wrong with a big bank, not at all. I worked for years for a big bank, and there's some advantages to working with a bank. But you want to be very careful with that timeline. If you have to close in, say, 3 weeks, let's say you found a house and for whatever reason you have to close quickly, we could close a loan in 3 weeks. There are some lenders out there that may not be able to close that quickly. So be careful. Customer satisfaction ratings. Atlantic Bay, one thing that we're very proud about is our customer satisfaction ratings. We've got a 99.4 customer satisfaction rating. This is going back 20 years of being in business. So customer satisfaction is very important to us. And lenders that have high customer satisfaction ratings, you'll have a better feeling. You'll kind of have a comfort level with them, right? You'll know that the communication is a little bit more, they're on top of it, right? There's this sense of urgency to get your loan closed and to work with you throughout the whole process. Personal fit, you also want to work with somebody that you're comfortable with, right? So the home shopping process here, of course, you want to sit down and you want to think through those things that are important to you when you're buying a house, right? The location, of course, the price point, new construction versus an existing pre-sale, that could be important to you. Some people like a brand new house, where others are comfortable with maybe buying an existing home that's a little older, that might need some little TLC maybe, or maybe some minor repair work. So those are some things that you want to think about with regards to the house. Doing your research online, open houses is a very good way to get out there and preview homes. So every Sunday, you'll see open houses. They're advertised, right, in the paper, online. You could schedule, a Sunday afternoon. You could bounce around to several houses, open houses, and you can get a feel for, what the house has to offer. So conditionally approved. Again, this going back to what I was talking about before the pre-qualification. Conditionally approved is taking that pre-qualification one step further, all right? And what that means is that when you sit down with your mortgage banker and you go through your loan application, we're going to do everything. We're going to pull your credit. We're going to gather your income documentation. We're going to gather your asset documentation, like bank statements. You probably already did this if you've been through the process already. We gather everything together, and we actually submit your loan. This is prior to you getting a contract signed and finding the house. So we get you approved ahead of time before you make the offer on the house, okay? And this is going to do a couple of things for you. Number one, it's going to make your offer, when you make the offer to that seller, right, we're going to give you a letter that says you're conditionally approved for the loan. So you're approved. All we have to do is an appraisal on the property, title work, and we can close. So a seller, if they're weighing a couple of options or offers, they might take your offer, even though your offer might be slightly lower than someone else's who hasn't been through that process yet. So it helps you negotiate the sale price, being conditionally approved. And the other thing it does for you too is it gives you peace of mind. You know exactly, hey, you know what, I'm approved for this loan, I'm going to close, right? Hey, one thing I want to encourage too while we're going through this is that if you have any questions, this is a small intimate group, right? So if you have questions at any point, stop me and I'll be more than happy to answer them. We don't have to wait to the end. Before you make an offer, you know, knowing the house is important. And this is something that your realtor is going to help you with, obviously, right? Your realtor is going to help you with making that offer. But just like I mentioned there with being pre-approved, it helps with submitting the offer when you're pre-approved. It also helps when you know what's negotiable, right, on the sale of that home. So a few things that are important to be aware of are home warranty, new appliances, new home systems like your HVAC system, repairs, you know, what repairs might be needed on the house, if you know of any, right? You're going to have an inspection done, but maybe you know of some repairs on that house that you want to negotiate on with that seller when you make that offer. Hey, maybe it's a new roof, right? Maybe you know that the roof has reached its life expectancy and you need a new roof. Well, you want to know that ahead of time when you make that offer. Closing costs. This is something that we're doing routinely now, where on an offer that's made, you can ask the seller to pay your closing costs, okay? So depending on the loan program, it's a little bit different as far as the percentage goes that a seller can pay, but I would say probably on just about 95% of the sales contracts that I'm seeing that are being written right now, the seller is paying the closing costs. So that can go a long way in helping you get into the house, especially if, you know, maybe you're a first-time home buyer, you know, maybe you want to limit your out-of-pocket costs, so the seller can pay closing costs for you.
I might have a quick question before you.
Fire away.
So I'm at the process right now where it's right before the inspection, and before, when I made the initial offer, I tried to negotiate the home warranty and the seller declined. But depending on the result of the home inspection, will I be able to renegotiate depending on whatever the result of that is?
Yeah.
Okay.
Absolutely. Yeah, whatever items come back in that that home inspection, you know, that's going to be some ammunition for you to go back and, you know, renegotiate. You know, you want certain things fixed,
Yeah.
you know, that kind of thing. Absolutely. When's the inspection being done?
Next Monday, or Monday coming up.
Okay.
So if they won't fix the items, maybe you could negotiate the home warranty
Yeah.
instead of the repairs?
Yeah.
Okay.
Yeah.
Or the price again.
Yeah.
Yeah.
Or have them lower the price, right? Yep. Yeah, it's a good question. So when it comes to the pre-qualification process, you know, some of the questions that the mortgage banker is going to ask you, right? When you sit down, you start talking about the, you know, your mortgage, they're going to ask you things like, hey, you know, where are you working, right? You know, what do you do for a living? You know, where's your income coming from? They're going to ask you, you know, probably how long you've been there, right? How much money do you have to work with? You know, that's one of the questions I ask all the time, right? Well, you know, how much money do you have to work with for down payment and closing costs? What do you plan to do with the property? You know, are you going to live in it as your primary residence? Or are you going to rent it out, right? It could be a second home. You know, it could be a property maybe that you're going to maybe want to just buy, fix it up, and flip it, right? So that's going to come up in conversation. The question, are you in the military? Very important one. The reason why? Not necessarily active duty, but you might be a veteran, right? And if you're active duty, you're veteran, reserve, you might have VA loan eligibility. And if you do, that opens up the VA loan. You know, it could be an option for you. And a VA loan is a great mortgage program. The big reason why is that there's no money down, so no down payments required. Who will be on the loan? Do you have a co-borrower? Something that we do on a regular basis, especially with first-time home buyers, is that maybe they don't qualify based on their income and right now where they stand. Maybe they're younger, buying a house for the first time. We can get a co-borrower. We can get somebody to co-sign for them. It could be mom, it could be dad, and relative, and they can co-sign to help them qualify for the mortgage. Is anyone helping you with the down payment? This is an important question right here. And the reason why is that, you know, when you're going through the mortgage process, you got to document your down payment and where it's coming from, right? Back in the day, there was a time, right? This goes back a little ways, right? This is going back 12 years ago when there were loan programs that were called stated income, stated asset, no income, no asset verification loans, where you didn't have to document as much, okay? So you could actually apply for a loan and you could get qualified just based on what you state your income and what your assets are. Yeah, those days are over. Now everything has to be documented. So it could be a situation where maybe you've got a relative giving you some gift money, right? That's fine. Mom, dad, they want to give you money to buy the house. Not a problem on loan programs, right? Happens. We just have to document it. So that could come up in conversation. So pre-qualification is kind of like a quick and dirty conversation with your mortgage banker. Get an idea of, hey, you know what, based on what you're telling us or telling me, hey, you'd qualify for a purchase price of this and a loan amount of X.
So that's good to do so that you're not shopping for a $300,000 house when you can only afford a $200,000 house.
Absolutely.
It tells you what you can afford. And,
Absolutely.
Okay.
Yes. Yes. So loan programs, basically you've got, there's probably about 6 or 7 different types of loan programs that are available today. Conventional loans. So have you heard the term Fannie Mae, Freddie Mac? Okay. So that's what they're referring to as conventional loans. So Fannie Mae and Freddie Mac, quasi-government agencies. They have your plain vanilla, right, 30-year fixed rate Fannie Mae mortgage loan. There's also USDA loans. Have you heard the term USDA before? Okay, USDA loan is a loan program that, similar to VA, no down payment is required. The caveat, though, to USDA is that the property has to be located in a rural area, okay? So here in our market, USDA rural housing, you're going to see the area for USDA, generally speaking, is going to be west of I-95. There are a couple pockets that are east of 95, kind of on the edge out there, right, that might qualify for USDA, but most of the properties are all out west. Effingham County, Rankin, and then further out west, of course, would qualify for a USDA loan. VA loans I mentioned. 100% financing. No money down is required. FHA, another first-time home buyer program. Really, FHA, that's who that's designed for, is for first-time home buyers. And I'll get into the down payment requirements on these in a minute, but FHA is designed for first-time home buyers. They're a little bit more flexible as far as guidelines go, where credit scores a little less. You don't have to be as high. You don't have to have as high a credit score to qualify. Down payments less, and the qualifying is a little bit easier with FHA. Condos. One thing on condominiums, be very careful, is that depending on the loan program, the condominium has to be approved. Okay, so if you're buying a condominium, you want to ask the realtor, ask them, hey, the term is a warrantable condominium. That's the term that's used in the industry. So you want to ask them if the condominium is warrantable. If it is, then you can do a conventional loan in that particular condominium. You also want to ask, if you're doing an FHA or VA loan, can you do an FHA or VA loan in there? Because there's a separate set of condo requirements in order to do an FHA or VA mortgage loan in a specific condo project. Not all condominiums are FHA approved. There's a very short list actually here in Chatham County that are FHA approved. So you want to find out ahead of time. State-specific programs. So what we're referring to here are programs that are, DPA stands for down payment assistance. So there are programs that are available that will provide, usually it's a state agency, federal government possibly, that will provide down payment assistance. These programs are going to be designed for home buyers that have moderate income, could be low income, low to moderate income, so they have some income restrictions on them, but there's down payment assistance that's available. In fact, there's one program that we're going to talk about in a little bit called the Georgia Dream program. Georgia Dream is a state of Georgia program, and they actually offer down payment assistance. In our county, here in Chatham County, they actually have a grant that's available. It's $15,000 that you can use for down payment assistance. And you can use that to go towards your down payment, your closing costs, they call them prepaids, which are buying insurance, that kind of thing. So could certainly help out. Jumbo loans. So the difference between jumbo loans and conventional are the loan amount. And the conventional loan limit right now is $484,350. So any loan that's above $484,350 is considered a jumbo loan, right? Anything below is going to fall into your conventional loan parameters. The difference between the two, if you're buying a jumbo loan, usually the interest rates are higher, a little bit higher. Down payment requirements are, you have to put more money down, and your credit score has to be a little higher. So, speaking of down payment requirements, here, I'm going to go back. I think I mentioned all this here. We talked about underwriting criteria here on these different loans, down payment requirements. This gives you an illustration here of the actual percentage of down payment that's required. So like I mentioned, FHA, 3.5%. Conventional is 3% down. So there's actually conventional loan programs that you only have to put 3% down. They call them the two programs are Home Ready for Fannie Mae's program, and Home Possible for Freddie Mac. Both of those loan programs are 3% down. So there are conventional loan programs that actually have a down payment requirement that's less than FHA, which is kind of cool. Not a lot of people know that.
How long have those been around?
They've been around for a while. But the thing is that not a lot of people were aware of that. So they're good programs, and the reason why, now, the conventional 3% down program really works well for somebody if your credit score is usually above 670, 680, right? Because, and we're going to talk about this a little bit, how credit score will has a relationship to your interest rate, right? But if you have a credit score of 680 or higher and you're doing 3% down, I always look at doing a conventional loan if somebody's putting 3% down, because it works out that the interest rate's very good. And the other thing that's it's lower than say FHA. The other thing that's very good is the PMI. Have you heard the term PMI? Private mortgage insurance. So PMI insurance, right, is required whenever you put down less than 20% on a loan. Now, FHA has mortgage insurance, right? Conventional has mortgage insurance. But the conventional loan mortgage insurance, when you put down 3%, is less than FHA. So it's really important to do a comparison. So what I'll do is I'll compare both products side by side. based on your scenario, your credit score, purchase price, etc., and we'll find the one that's going to be best as far as interest rate and the PMI. VA and USDA, VA doesn't have monthly mortgage insurance. It's another benefit to VA. You can put 0 down, and there's no monthly mortgage insurance on VA. The only thing VA has is it has a one-time, what they call a funding fee. VA charges it. It's a one-time fee. You can actually finance that amount on top of your loan. USDA has a very small monthly mortgage insurance amount. But again, all three programs have options for minimal down payments.
Does the mortgage insurance, does it automatically come off when you hit 20%?
Great question. Really good question. It does not. So there's two ways that you can remove mortgage insurance on a conventional loan, okay? If you pay on let's say you have a 30-year fixed rate conventional loan with mortgage insurance, if you pay based on the amortization schedule, right, once it gets to 78%, it automatically comes off. So 78% loan to value. Mm-hmm. So you'd have to have 22%, equity based on your initial purchase price, just by paying your mortgage payment over time. The other way that you can have it removed is that if you have to have another appraisal done. So let's say you buy the house, $200,000 purchase price, you have mortgage insurance, maybe you put 10% down, right? So you did a loan amount of $180,000. In 3 years down the road, the house appreciates in value, and it's $300,000, right? But you're not quite, based on your amortization, you're not quite at that 70. You're at 80 based on the new value, but not on the initial one. You'd have to have a new appraisal done, and then submit that to the bank or the mortgage company, and then they'll go ahead and remove it for you. One thing with FHA, the mortgage insurance never comes off. So if you do an FHA mortgage loan, the mortgage insurance is on there for the life of the loan.
Unless you refinance.
Yes, unless you refinance. So that's one of the other things that goes into that discussion about what program is better, because if the conventional loan, you can remove the PMI after a while, whereas FHA, you're stuck with it.
Which is how much per month on an average-ish?
Yeah, so let's use the example of, say, $200,000 home, right? Your FHA monthly is, again, it's dependent on your credit score, right? So let's say you have a 720 credit score, right? And let's say you've got, here, I'll tell you what it's going to be exactly. Let's say your loan amount's $200,000. It can be pricey. That's why I like to try to avoid it at all costs if you can. But on $200,000, it's about $150 a month. Wow. Yeah, and what mortgage insurance is too, is that it's not insurance for you, okay, as a homeowner. It's insurance for the lending institution. So what it is if that loan were ever to go into default, let's say you stop paying on the loan, right? A few years down the road, part of the mortgage company or the bank that funded that loan, part of their exposure to that loan is reduced because of the mortgage insurance. So it's not insurance for you at all. It's just insurance for the bank. Yeah, if there's a way to avoid it, we want to try to avoid paying mortgage insurance if you can. Can't always be done though.
Or at least not getting stuck for it for the life of the loan.
That's correct. Yep. So, and I'm going to go into credit scores here in a little bit, but one of the differences, like FHA and VA, their credit score minimums they're lower than, say, a conventional loan. So FHA is a great loan program. Maybe somebody, maybe somebody has, they have some credit issues, right? Maybe they had a couple of slow pays on a credit card, and maybe their credit score is not 720, right? But maybe it's 590. We can actually go down to 580 on an FHA loan. That's the minimum. So So FHA is going to be better for somebody maybe that has less than perfect credit. It'd still qualify for a mortgage. So down payment assistance programs. This is where state agency is going to step in and give money for down payment assistance. In the folder here, there's a couple of flyers in there. That first one that you see there, that's on the left-hand side. That's the Georgia Dream program. And this is just a fact sheet here. It gives you kind of a high-level overview of the program and how it works. But essentially what it is that Georgia Dream it could be either a conventional loan, it could be an FHA, it could be USDA even, right? But the big thing is they give down payment assistance. So here in Chatham County, the reason why we have $15,000 available in down payment assistance, they call it the hardest hit fund. So, and there's another flyer in there right behind it, which is the Georgia Dream Hardest Hit Fund. So what the state of Georgia did, they set aside money to help spur the economy in particular counties that were hit by the economic downturn about 10 years ago. That's when this all came about. And they still have this available here in Chatham County. The number of counties that down payment assistance is available in now is down to about 7. There's 7 counties where you can still get down payment assistance for $15,000. Bibb, Chatham, Muskogee, Clayton, DeKalb, Douglas, and Fulton. Now, if you're not in one of these counties, you could qualify for just $5,000 in down payment assistance. That's what Georgia Dream gives, $5,000. If you are a firefighter, police officer, teacher, an educator, EMT, right? $7,500 is available. So, good program to go with for first time buying a house for the first time because it gives you the down payment assistance. One of the drawbacks, it's not really a drawback, but the interest rate's a little bit higher on the Georgia Dream loan programs. So if you compare an FHA loan, a regular FHA loan, where you're not using down payment assistance, the rate is probably about 0.3% different, higher with Georgia Dream. The down payment assistance, the way that works, let's say you get $15,000 in down payment assistance, you have to stay in the house for a period of time, okay? 5 years. So as long as you stay in the house for 5 years, if you use that money, they're going to forgive it. So it's like a forgivable grant. So if you decide to sell the house before 5 years, they're going to recoup some of that money. It's prorated. So not really a drawback, but it's something to be aware of if you're thinking about going with the Georgia Dream program. Yes,
On
sir.
the Georgia Dream, is there a cap? Like I get $15,000 if I spend X amount of dollars, or is it?
No.
What are the minimum price?
There's no minimum. There's a maximum, however, okay? So in Bibb, Chatham, Muskogee's Columbus, Bibb, Macon, $200,000 is the maximum purchase price. But you could buy a $60,000 home and qualify for the $15,000. That's a big chunk for down payment, right? Yeah. That's your 20%. Any questions about Georgia Dream?
With the pre-qualification, if we get pre-qualified with the plan to pay, then roll to the Georgia Dream, because I hear it takes a little bit longer. With that pre-approval in place before we shop for houses, can we alleviate some of that time?
Yes.
Okay.
Yes, for sure. The Georgia Dream processing time from, when you submit your loan application to getting it closed, you really want 45, maybe close to 60 days sometimes, just because we have to work with the state of Georgia, right? for their loan documents and that kind of thing, so it takes a little bit longer. But yeah, absolutely. If we get you pre-approved first for the loan, for the Georgia Dream Loan Program, it'll cut down on that time because we'll have all the heavy lifting done ahead of time, right? Everything will be pre-approved. So yeah, yep. Turn that into a 30-day timeline. So credit scores, get a lot of questions about credit, and the basics behind the credit score. Credit scores range from the lowest 300, highest 850. I have never seen a 300. I have never seen an 850. And I've been doing this for 25 years. I've seen some that are close to maybe 850, close, but not quite. That's really good credit. Okay, never seen a 300. Now, credit is a really important factor when getting qualified for a mortgage, right? Your interest rate's dependent on it. Getting approved for the mortgage loan, it all really hinges on credit. So credit is something that is, Credit Karma, right? You can check your credit. There's other. What's the other one that I'm thinking of that you can do for free one time? Yes, thank you. Do that. Check it, especially before you're thinking about buying a house. You want to know where you stand. Now, when I sit down with you and I do your loan application for pre-qualification or pre-approval, we're going to pull your credit. I'm going to go over it with you. The good thing about credit is I have some tools at my disposal that I can help with improving scores. Now, I don't do credit repair, so I can't fix your credit, right? So if you have if you have some issues with some collections, or you have some tax liens and things like that, I can't help repair it. But one thing I can do is I can certainly analyze your credit, and I can give you some really good ideas on how to improve your credit score. So I have what's called a credit simulator, and it's a tool that I use where, looking at your credit, let's say maybe you've got 3 or 4 credit cards, and those 4 credit cards they each have a balance of $2,000 on them. I can play with the simulator, and I can say, okay, well, what if we reduced your balances by 500 on this one, 500 on this one? Maybe there's a small collection, I don't know, Verizon, there's a medical collection or something, $70, $80. I can show that it's paid off. And in the simulator, it will tell me exactly what your score will go up to. Yeah, really cool. I mean, it happens a lot because I've had folks that, I had one recently where somebody had he was applying for a conventional loan, and he had a 608 credit score. So 620 is the minimum on conventional. So we weren't there. But I was able to go in there and use the simulator and show him, hey, this is what you need to do. A couple things. He got up to a 640. We got him approved, closed. So, credit, going through it with your mortgage banker, really important. Again, I can't repair it though. I can't talk to a creditor and things like that, but I can give you a lot of advice. The other thing too is maybe somebody doesn't have a lot of credit established. So I can give you some advice on how to establish, maybe it's a secured credit card, right? Maybe you've got maybe first-time home buyer, you don't have a whole lot of credit, right? So you can take out a secured credit card with a bank, and that will help establish your credit. So there's little things like that, little tricks, that we'll talk through, that will help improve your credit score. Excuse me. So the credit report that we use is a tri-merged credit report. And what tri-merged means is that we pull data from the 3 major credit bureaus. So Equifax, Experian, and TransUnion. So we're going to get 3 credit scores. That's going to be, that's all of your credit, right? Anything that's reported out there is going to show up. And we're going to have 3 different credit scores. We take the middle credit score when qualifying you for the mortgage. So you might have a 650 Equifax, you might have a 625 or you might have a 618 Experian, and maybe your TransUnion is 605. We have to use the 618. So we go right in the middle. So some of the things that the agencies use. So the exact formula we don't know. We don't know how exactly we don't, right? We have a pretty good idea. So some of these things that, that they're going to look at are the types of credit history. Do you have credit cards? Do you have installment loans? Have you been paying on time with those? Credit inquiries. So this is important. One of the things you want to be very careful about when you're buying a house is you don't want too many people, too many mortgage companies, banks, pulling your credit in a short period of time. The reason why is that too many credit pulls in a short period of time, they call them credit inquiries, they could negatively impact your credit score. I had somebody the other day who was shopping for a car recently. And they went, what do you do when you go shop for a car? You go to different dealerships, right? Well, she had every dealership pull her credit report. And there was like 8 of them in like a weekend. And, again, I don't know the exact formula, but she was shocked at her credit score because there were so many credit pulls. And then the mortgage company pulled it too, so her credit score dropped like 50 points.
I have a question. If you have so say you have student loans, credit cards, and a car loan, and then
Yep.
you pay the car loan off, would that then actually reflect negatively because you have?
You know what? It could, yes. Paying off, and I've done this in the simulator, right, with folks, where we say, well, what if I paid off my car? What if I paid off my car note that has a $4,000 balance? It actually took points away because they were paying off a trade line that was an installment loan. Because the credit agencies like to see different types of credit established that you're paying on it, open. So in that case, it actually hurt it. So kind of every case is different, but it could actually negatively impact you by paying off a car. Could.
Okay.
That's why I got to do the credit simulator with you and show you.
Yeah. Okay. Cool.
Length of credit history, right? How long you've been in the credit bureaus. Outstanding balances, right? So if you have credit cards, maybe you've got a $5,000 limit and your balance is $5,000, right? You're right at the limit and you have a couple of cards like that. It's not good. It's going to hurt your credit score. And then, of course, payment history, right? If you have any 30-day lates, 30, 60, 90-day lates on a credit card, a car loan, student loan. Tell you one thing right now, student loans are, it's a problem. Not so much where everyone's late on them, but a lot of people have student loans coming out of school. And I see it routinely. One thing is that unfortunately, even if you're in forbearance with a lot of loan programs, they still count the student loan payment against you. Yep. So that's the debt to income ratio. This is going to determine how much of a mortgage payment you can afford, right? So we're going to look at your monthly debt that you have outstanding. We're going to add up your minimum payments on credit cards, your car loan. We're not going to take into account any bills that you have like auto insurance or utilities. It's strictly, your debt that shows up on your credit report. Maybe you've got a loan for furniture, right? Boat loan, things like that. So we take your debt, which is the numerator, income is the denominator, and that determines your debt to income ratio. Generally speaking, on a debt to income ratio, you want to be, 43% is kind of like that maximum magic number with debt to income ratio with most programs. You can, however, right, you can get approved higher debt to income ratio, like on an FHA loan, you can get approved. I've seen 50% debt to income ratio get approved. It depends on your credit score. So the higher the credit score, let's say you have an 850, right? Which I really haven't seen, but let's say you had one. 850, superb credit, right? And maybe your debt to income ratio is 50, right? You got a very good chance of getting approved for the loan. So kind of look at both, debt to income and credit score. So how much home can you afford? This is kind of just a real good, rule of thumb, right? 50, 20, 30. So 50% toward recurring payments, which would include your mortgage payment, right? That you're going to have. So 50% of your income, your gross income, that's what we look at, right? From a budget standpoint too, you might want to look at your net, right? 30% towards flexible spending, and then 20% toward financial savings, right? So 30% towards, your hey, that's your right, you're going out money, right? Meals, entertainment, that kind of thing. And then 20% towards savings. That's something that's very important that you always want to be thinking about, especially for first-time home buyers, because sometimes I know that with, most difficult thing usually up front when you're buying a house for the first time is that down payment, right? So you got to exhaust some savings, right? And sometimes you're using all of your money for down payment, right, or close to it. But you want to always be thinking about, hey, well, how much money can I put aside, every month going forward if I take out this mortgage with this kind of a mortgage payment? Savings is important, right? You start when you're young, right? You build it up over 20, 30 years, and you get yourself a really nice nest egg. So savings is something that you always want to consider. So here's your PITI payment. You answered this before. Your mortgage payment, it's going to consist of your principal, right? That's the amount of the mortgage payment that's going to go towards paying down the loan. The interest, of course. One thing you're going to see when I'll sit down with you and do this for you when you apply for the loan is we'll do an amortization schedule, and I'll show you that like on a 30-year amortization, all those payments that you make initially up front, most of those payments go towards interest. So almost all of it. Like your first 12 months, it's all interest. But then as time goes on, more of your payment is allocated towards paying down the principal. And I can show you that in an amortization schedule. One little trick here is this. On a 30-year fixed rate mortgage, if you make one additional payment, mortgage payment per year, just one extra payment per year, say your $1,000 monthly mortgage payment, and you make one additional mortgage payment per year, it'll reduce the life of that loan. It'll knock it down. It'll turn a 30-year amortization into less than 25 years. So, have you heard the term biweekly mortgage payment? You heard that term before? So that's kind of it was a creative way to help reduce principal on a loan, where you split your payment in half, your mortgage payment in half, and then your payment comes out every 2 weeks, biweekly. And what that does is pretty much the same thing. It's applying one extra payment per year, and it knocks down the life of the loan tremendously. Actually, it's probably closer to about, it knocks about 4 years off the life of the loan. It turns a 30-year into about 26-year, roughly.
$100 extra a month on 200,000 knocks it off 7 years.
Yeah, and that's something we can do too on an amortization schedule. Is that I can show you. All right, so what if you made so much more towards principal every month? Maybe you wanted to send in an extra $100, $50. We can do that, and I can show you the numbers. And it's pretty cool because it shows you, whoa, if I just make a little extra every month, I'm going to get this house paid off a lot quicker.
Is it that all the extra money you pay per month over that minimum amount goes towards principal?
Yes, correct. Yeah.
Automatically, or do you have to specify?
Usually have to specify. Yes. When you get your payment coupon, there will be a section on there that will say additional principal, and you want to put that in there. Make sure it goes towards principal.
Don't check the additional interest.
Do not. That is correct. Don't do that. So then principal interest, taxes, right? Your monthly property taxes. If you're buying in city limits here, city taxes would also be part of that. So be careful if you're buying in the city. City taxes will be added to the county taxes. And then insurance. So your homeowner's insurance. Now, condominiums, insurance works a little differently. You have a master insurance policy on the condominium. So every time you make your condo association, your dues, pay them monthly or quarterly, part of those association dues are going to go toward paying the master insurance policy. Okay? If you buy a single family home, you have to go out and obtain a homeowner's insurance policy from any insurance company. You know, you're free to go anywhere you want, but insurance company will write the homeowner's policy for you. Flood insurance, be careful with flood. There's certain areas. They changed the flood map recently, so actually got better for some people and worse for others, but I think most of it was an improvement. But if you're in a flood zone, you have to have flood insurance. And depending on the type of flood zone that you're in, if you're in a high-risk flood zone, your flood insurance can be very, very expensive. So you want to check. That's another thing to check when you're doing your research on the property that you're making an offer on. You want to find out, hey, is it in a flood zone? We do a flood certification. That's part of the approval process with the mortgage. So it will tell us up front what flood zone you're in. Your insurance agent will know too. They can look it up. So closing costs. So there are going to be costs associated with obtaining the mortgage loan. So at Atlantic Bay, I will tell you that we have one fee. It's $895 that we charge. That's our fee. Okay, that's the one fee that we have to Atlantic Bay. There are also going to be fees, and this is going to vary depending on the lender that you go with. You know, they might not be $895. It could be $1,200. It could be $1,400. They could call it an origination charge. They could call it an administrative fee. They call it different things. But our fixed fee is $895 on all of our loan programs. So other costs associated with the loan, appraisal, this was a third-party cost. So we're going to have an appraiser when you get the contract signed. We're going to have an appraiser go out to the house, do not a full inspection like a property inspection, but the appraiser is going to go out, take pictures. He's going to do a comparable market analysis on there to make sure that, hey, you know, the house is worth what you're paying for it. One of the things with FHA and VA, there's a clause with FHA and VA is that the house has to appraise for what you're paying for it. And if it doesn't, you can actually walk away. So it's like a little safety net there.
Or negotiate.
Yeah, or negotiate, absolutely.
Okay.
Go back to the seller. So yes, appraisal comes back, and if it's lower, you know, you go back and negotiate with the seller. Hey, my appraisal came in, right? You know, I can't, you know, because one of the things that we're going to do, as far as the mortgage goes, is we base your loan amount on the lower of the two being the purchase price on the sales contract or the appraised value. So if you get a low appraisal, we have to base your loan amount on the lower amount, meaning you have to bring more money for down payment. The credit report fee, we're going to charge a credit report fee, right? So you're going to have appraisal, you're going to have credit report fee, there's a flood certification fee like I mentioned. You're also going to have what's called title company charges. So you're going to have real estate attorney related charges. You're going to have a real estate attorney close your mortgage loan for you. So what they do is they're going to do, and it's a very important part of this whole process, because they do what's called a title search, and they give you what's called title insurance. And what title insurance is, it's insurance, right? They're making sure that the ownership of that property is being conveyed correctly from the seller to you. So you're the new owner. Their search is going to see if liens, encumbrances, they search the property records all the way back, make sure that everything was transferred properly, so that you know, you know for sure that when you're closing on that house, when they give you that title insurance policy, that you're the rightful owner, right? So it's very important. They're also going to you're going to sit down and close with the real estate attorney, and they're going to go through all the documents with you. So you're going to sign the mortgage and the note, and you know that's the end of it. That's the last part of the process, is when you're sitting down with that real estate attorney, going through and signing all the paperwork. So there's costs associated with that. Now, escrows, the escrow account, have you heard the term escrow account before? So yeah, sometimes there's some confusion around this, and and it's really important that you're clear on this, right? How it works, because every time you make your mortgage payment, right? Part of your mortgage payment, like we were talking about your PITI payment there, you're paying towards the taxes and the insurance on the property. So what's going to happen is that, think of it like as a savings account. Every time you make your mortgage payment, part of your mortgage payment is going into that savings account. The bank sets aside for you so that next year, when the property tax bill comes in and when your homeowner's insurance bill comes in, we take the money from your savings account and we pay those bills for you. It's called an escrow account. Fancy name, it's a savings account, basically. It's what it is. So you're not going to have to write the check for next year's property taxes out of your own pocket. You're going to get a copy of the bill, okay? You're going to get a copy of the insurance policy that says your insurance premium is this. But the bank or the mortgage company is going to have money in that escrow account to pay it. So part of what that real estate attorney is going to do at closing is, you're going to see this on your closing disclosure when you go to closing, the escrow is going to be taken care of by the attorney there. It's going to be all detailed, show you how many months they're taking out, right, and how they're dispersing those funds. Some of the other closing costs that you're going to see, state of Georgia here, you're going to see there's state taxes, right? So you're going to see state taxes on there. You're going to see recording fees. So there's a whole list of different items that are going to add up, to your total closing cost number. So one of the things that I'm going to do with you when we sit down and go through all these numbers is I'm going to give you a closing cost worksheet ahead of time, right? So that you know exactly, and it's very detailed, and it's very accurate when it comes to, I can estimate what those closing costs are going to be for you. It's going to show you everything broken down, what those closing costs are, and what that final number is going to be at closing. We call it a closing cost worksheet up front. You're also going to get what's called a loan estimate, and the loan estimate breaks everything down for you. They used to call it a good faith estimate back in the day. It changed. Now it's called the loan estimate. But that'll show you everything, all the fees associated with buying the house. So I mentioned some of these things here already. As far as the process goes, the appraisal determines the market value. We talked about title search and what the title search is going to do. Home inspection, I will tell you this: there's certain inspections that are required with certain loan programs, but I wouldn't buy a piece of property without a home inspection, full home inspection. I would recommend that always do it. Termite, right? If there's a septic tank, do the inspection. Spend the money on it, right? So if we identify, some areas that need to be, some things that need to be replaced, or there's problems with something, right? The roof, the HVAC, then you can go back and negotiate with the seller. But that home inspection is the home inspector is going to go out there and really and check everything. Electrical, right? Plumbing. They check everything in that house and they make sure it's working properly. And then, the last thing, right before you go to closing, before you go to the attorney's office to sign all your paperwork at closing, is you're going to do a walkthrough. So you're gonna go with your realtor before you close, and you're going to preview the house or the condominium again, and you're going to make sure that nothing's changed, right? That there's no holes in the wall and there's no damage or anything, right? So you're going to do that final walkthrough, right before you go to closing. Application checklist. So the documentation that's required for the mortgage loan application, we're going to need to verify income. So pay stubs, right? Probably W-2 forms. We're going to need to verify your down payment money. So we're going to need bank statements. Usually we ask for 2 months bank statements. We might ask for tax returns depending on the nature of your employment. Maybe you're self-employed, and if so, then in order to verify your income, we need the last 2 years' tax returns, W-2 forms. So there's a list here, just kind of a checklist, if you will, of what you're going to need to bring to the mortgage application. Don't worry about taking that with you. There on the back of my card. I think my card's on the right-hand side of the. Yeah, if you take that out, I actually have the checklist on the back of my card, so it makes it easy on you. Tells you everything you need to bring to the loan application. So that does it as far as the process goes. I want to open it up now. Any questions? Anything at all? There's no such thing as a stupid question, right? So if you have any questions, I'd be more than happy to answer them.
If you make that extra mortgage payment, how do they know where that extra money goes? If it goes to your taxes or your principal or
On your mortgage statement that you're going to get monthly, there's going to be a section on there that's going to say additional principal. So you're going to check that box.
And so if you're paying online, they'll likely have a spot where you can specify.
Yes. Yeah. Yes. Yeah. Yeah. Be real careful with that, though. Because if you just send in 50, maybe your payment's $1,000, you send in $1,500, they're going to assume that it's going toward interest unless you specify it. Yep. Yeah. Yep.
Well, thank you very much. That was very informative.
You're welcome. Be more than happy to stay afterward if you have questions. Or of course you can call me. My phone number's on my card. Best number to get me is the cell phone number. Just you call me anytime with questions, or if you want to sit down and go through the loan application process.